Figma. You've definitely heard the name. It's the tool designers practically live in, and now it's a huge new company on the public markets. Today, we're going to tear down the business and the financials of this creative powerhouse. Let's get right into it.
I mean, this is the real question, isn't it? How does a company that at its core makes a digital canvas for designers end up with a valuation of over $11 billion? It's a pretty wild story, and over the next few minutes, we're going to put all the pieces together.
All right, here's our game plan. First, we'll look at how Figma evolved from just a tool into a whole platform. Then, we'll unpack its incredible growth engine. After that, we're diving into the tricky financials to figure out what the real profits look like. And finally, we'll size up the bull case versus the bear case for its future.
Okay, so let's start at the beginning. What exactly is Figma? We need to understand its core business to see how it got so dominant. At its heart, Figma is a shared digital canvas that lives right in your browser. Think of it like the one place where designers, developers, and product managers can all work together at the same time to build software. And you've definitely seen its work. If you've ever used Google Maps, scrolled through Netflix, or called an Uber, you've touched a product that was designed in Figma. Now, what's really wild is the speed of this evolution. Look at this. Figma started with one product in 2015. By 2024, it had 4. But then, in 2025 alone, it doubled its entire product line, adding 4 brand new things. We're talking website building, AI prototyping, the whole shebang. This isn't just a design tool anymore. It's a full end-to-end platform. And that expansion led to this, 95%. Just let that sink in for a second. Almost every single one of the biggest companies in the US relies on Figma. That kind of market share is it's staggering. It basically means Figma is the industry standard now. So how on earth did they do that? Well, that brings us to the real magic behind Figma, its incredible growth engine, and why its customers almost never leave. It all comes down to this brilliant flywheel. It starts super simple. A designer or a small team starts using the free plan. They love it, so they share it with coworkers. Before you know it, the whole company's design system is built inside Figma, which creates this massive lock-in. All that viral bottom-up use then turns into a big company-wide sales deal. And the whole thing gets supercharged by a community of over 10,000 plugins that just make the platform even more useful, which, of course, attracts even more new users. It just feeds itself. And if you want to see that flywheel in a single number, this is it. 136% net dollar retention. What that means is, not only do customers stick around, but the ones you have are spending 36% times more money with you the next year. For a software company, that is absolutely elite. And just to be super clear on what that means, net dollar retention, or NDR, is a crucial health metric. It basically asks how much of the customers we had last year paying us this year. Anything over 100% is good, but 136%, yeah, that's exceptional. It means your business is growing even if you don't add a single new customer. And if you needed any more proof of how sticky this platform is, here you go, a 97% gross retention rate. This number is even simpler. It just measures how many customers leave. And what this tells us is, basically, nobody leaves. Once you're in the Figma ecosystem, you stay there. So, what happens when you have that kind of viral growth and customers who never leave? You get this, a revenue chart that looks like a rocket ship. The business has basically doubled in just 2 years, blowing right past that huge billion-dollar-a-year milestone. Okay, now for the tricky part. At first glance, Figma's financials can be, well, they can be really confusing. So we're going to decode them together and figure out where the actual profits are. So here's the big puzzle, right? How in the world can a company report a massive loss of over $1.2 billion, but then also say it had an adjusted profit of almost $167 million? It sounds impossible, like you're looking at 2 different bank accounts. But there's a reason, and it comes down to a huge one-time paper expense. And the culprit is something called stock-based compensation, or SBC. This is a non-cash charge. It's an accounting rule. The important thing to know is that it's not actual money leaving the company's bank account. And in 2025, a huge batch of these grants related to the IPO hit the books all at once, creating this massive $1.36 billion paper expense that made the official numbers look way worse than they really were. So if you want to see the real health of the business, you just have to follow the cash. And when you do, you find this, a 23% adjusted free cash flow margin. That means for every single dollar in revenue Figma brings in, it generates 23 cents of actual cold, hard cash. That is the sign of a very profitable and very healthy business.
And all that cash has allowed them to build, well, a fortress of a balance sheet. They have zero long-term debt. They're sitting on a massive pile of $1.7 billion in cash. And all of this incredible growth, it's completely self-funded from their own profits. They don't need to borrow a dime.
All right, so with a super healthy business as our foundation, what's the argument for Figma's continued success? Let's lay out the bull case, which really comes down to AI and its ever-expanding platform.
The bull case really stands on 4 strong pillars. First, they are the dominant leader, and their customers are deeply locked in. Second, that incredible 136% retention means their existing customer base is a compounding growth engine. Third, with 8 products now, they have a ton of opportunity to sell more stuff to the customers they already have. And finally, there's this huge international opportunity. Get this, 85% of their users are outside the US, but that only accounts for about half the revenue. There's a lot more money to be made there.
But what about the threat of AI? People worry it could replace designers. Well, Figma's CEO Dylan Field has this really powerful take on it. He says that as AI makes coding easier, the really valuable work, the creative, subjective, human part of design, actually becomes even more important. In his view, AI doesn't make Figma obsolete. It makes it essential.
Of course, it's not all sunshine and rainbows. For every bull case, there's a bear case. So let's flip the coin and look at the real risks, the potential red flags that could slow Figma down.
There are 4 big ones you gotta watch. First, all these cool new AI features, they're expensive to run, and it's starting to squeeze their profit margins. Second, their new plan to charge customers for AI use is brand new and totally unproven. We have no idea if it will work. Third, the CEO just got a massive new equity award, which means a lot of future dilution for other shareholders. And finally, the stock itself is expensive. It's priced for perfection, which means even a small slip-up could cause a big drop.
And then there's this one other kind of weird detail. The company holds almost $89 million of its cash in Bitcoin and a Bitcoin ETF. It's not a huge piece of their cash pile, but it's a pretty unusual choice for a software company. It introduces a bunch of volatility that has absolutely nothing to do with their core business. It's just something to keep an eye on.
So, at the end of the day, here's where we land. Figma is, without a doubt, a world-class business. It has a huge competitive advantage and a customer base that absolutely loves it. The real debate isn't about the quality of the company. It's about the price of the stock. You have a premium company trading at a premium price. And that leaves us with the billion-dollar question. Figma is a world-class business, but is it a world-class investment?